Good afternoon, everybody. My name is Casey Barnett, and I am the president of ChemEd Business School. And ChemEd is the only institute of higher education in Cambodia that specializes in accounting, auditing, and tax in accordance with international standards. And it's our pleasure to support you, professionals, in Cambodia. And as you know, Cambodia follows CIFRS, which is the same as IFRS, and CIFRS resumes, which is the same as IFRS resumes. And we're here today with a very special person. His name is Jan Pereiras, and he comes to us today from London, where he is working with the International Accounting Standards Board of the IFRS Foundation. And one project that he contributed to and contributes to is the new standard that's he's going to present today, IFRS 19 subsidiaries, which is a step towards making financial reporting relevant and useful and not a burden to preparers. And Mr. Pereiras is special because he is someone who worked on IFRS 19, and he's special to us in Cambodia because Jan Pereiras is a CPA who was the director, the audit director at EY Cambodia. So Jan knows us very well in Cambodia. He understands our environment. He understands the companies that are reporting. He understands you who are working as an accountant, who is working as an auditor. And I would like to say, Jan, thank you very much for taking your valuable time on a weekend to be with us here in Cambodia to present to us IFRS 19. And everybody who's here today, welcome. I hope you enjoyed the presentation. And again, Jan, wonderful to see you. It's really awesome that you can share with us back here in Cambodia what you've been doing for the last 7 years with the International Accounting Standards Board. Thank you very much. And that's all I will say today. And I'm going to pass it over to Jan.
Thank you so much, Casey. And it's my pleasure to join everyone today. So before we start, let me express my gratitude to ComEd for hosting this event and to all the participants, Susaday Soksabay. Thank you for spending your Saturday afternoon here to learn about the new standard IFRS 19, subsidiaries without public accountability disclosures. So let me just share my screen. There. So I hope everybody is seeing it. So again, I'm Carlo Pereiras. I work for the IFRS Foundation, and I'm a technical staff of the IASB, or the International Accounting Standards Board, here in London. So as Casey mentioned, before moving here, I actually work and live in Cambodia. Phnom Penh was my home for about 5 years. So as a technical staff, I support the IASB in developing IFRS standards, specifically on the area of research, outreach, and redeliberations. So I am actually the project manager of the standard that we are discussing today. So before working on IFRS 19, I also work and help the board on some IFRIC interpretation questions. I also help on developing the educational modules and materials on the IFRS for SMEs. So I hope those materials have been very helpful in Cambodia. I also work on the discussion paper related to business combinations under common control. And then eventually moving to this project on IFRS 19. So I think that's enough information about me for now. Let's have a quick icebreaker since I cannot see your faces. So that I could get some idea on the background of our audience here. So I think we do have a good number. This is actually quite surprising and it's still climbing. So thank you very much for all the interest. So what you can see on the screen now are options about your background. Just want to see the background of the participants that who are joining. I think I can see some of the responses coming in. I think majority are students, so that's really good. There's a good number of auditors or consultants who are joining, so this standard is really for you. A good number of accounting staff and non-accounting staff. Some number on managerial and executive positions. That's really good. Wow. So we do really have everyone here with so much varied backgrounds. So I really hope that you'll find this session interesting. So this standard, so as Casey mentioned, reduces burden. So it's really targeted for preparers. Great. So they're still coming in. So I guess the polling function works. So throughout the slides, you will see a number of polling questions just to engage. And hopefully, well, if there's a next opportunity next time, we could do this session face-to-face. Okay. So let me move on to the next slide. So again, the agenda for this afternoon is to give an overview of what IFRS 19 is about. So we will talk about the background of the project. So what the problem it's trying to address and how it came into about. An overview of the requirements in IFRS 19. How the IASB or the board plans to maintain IFRS 19 and the expected benefits of using IFRS 19. Now, if you have any questions or clarifications, feel free to drop it in the Q&A function of the webinar, and I'll try to answer them at the end of every section. So the presentation is divided into 4 topics, as you can see. So probably let's plan to take a short break at the end of the second topic. And then before we go into the details, let me just emphasize that any views or opinions that I will express today are of my own and not of the ISB or the IFRS Foundation. So with that, a quick glance on what IFRS 19 is about. So on its very core, IFRS 19 is a reduced disclosure standard. It requires less disclosures than what is currently required in IFRS. It's part of IFRS, hence it's IFRS 19, so it's not a different reporting framework. Subsidiaries that applied IFRS 19 can still say that their financial statements are prepared based on IFRS. As I said, it's a disclosure-only standard. Therefore, a subsidiary applying IFRS 19 will apply its disclosures along with other requirements in other IFRS. So for example, if you're accounting about an item of PPE, so say a building, so you will determine how you recognize and depreciate that building using IAS 16. So the main standard appropriate for PP&E. And then you apply IFRS 19 to know what disclosures to provide. IFRS 19 is voluntary and is not required. Subsidiaries are not compelled to use it. Compared to other standard, IFRS 19 offers relief to some subsidiaries. So it does not change or add any new requirements. So it's really more into reducing the burden for preparers. So if the subsidiary thinks that they are better off doing what they're currently doing, so keeping their status quo, then they are not required or compelled to use IFRS 19. If the standard is not for you, then you don't have to use it. So it's an option for other subsidiaries to use. IFRS 19 is expected to simplify reporting systems and processes, thereby reducing the cost of preparing eligible subsidiaries' financial statements and even group or consolidated financial statements. So we will discuss more about the benefits of using the standard later in the presentation. Lastly, the standard is effective 1st of January 2027, but it's available for use immediately. So let's talk about how the project started. So this is the problem that the ISB is addressing. Stakeholders informed the ISB about the challenges and the complexity they are having on preparing subsidiaries' financial statements. So think about a scenario where a parent, so the one at the very top, preparing IFRS consolidated financial statements. You will remember that there is a requirement in IFRS that for that consolidated financial statements to be prepared, the subsidiary has to prepare IFRS numbers and disclosures so that the parent can include those numbers in to prepare its consolidated financial statements. So for auditors here, so I think we do have a good number of auditors and consultants, you will remember if you've been involved in those group reporting work. So those reporting package communications we got from other teams overseas. So it's a reporting package given to components, mainly subsidiaries, to fill them up for consolidation purposes. Now, group and parent companies observe that in many instances, their subsidiary has to prepare their own financial statements, or what we call statutory accounts, which I think in Cambodia they do require. So if those subsidiaries, so the one at the very bottom, the one on the left, if those subsidiaries accounts are based on local GAAP or SME's standard, then that means they have to prepare a reconciliation of those local accounts to IFRS. So this is what we call dual reporting. So where a subsidiary has to convert the numbers from their local accounts to IFRS. Now, on the other hand, so the one on the right, if the subsidiaries are using IFRS, so even though they don't need to maintain dual accounts, they find complying with the disclosure requirements, which are pretty expensive, burdensome. So especially for wholly owned subsidiaries, it's only the parent who are using their accounts. So even when I was working in Cambodia, I'm hearing clients telling me, why do I have to prepare these disclosures? Why are you needing all this required information? So you will notice, regardless of the framework that the subsidiary is using or applying in their statutory accounts, first, they are already using IFRS, either in their statutory accounts or for group reporting purposes, or they have challenges. Either they maintain dual accounts because they're using SMEs, or they find the disclosures required in IFRS too much to comply with. So the ISB solution is the one on the next slide, is to develop IFRS 19. So this standard will enable certain, not all, but only some, certain subsidiaries to use IFRS, but with reduced disclosures. So instead of maintaining a reconciliation of two accounts, the subsidiary will only need to maintain one single set of accounting records. Their auditors would probably need to do also their work once, or probably the work would be less. So aside from this simplification, the disclosures the subsidiaries have to provide and the auditors to audit will also be reduced. So let's look at the project timeline. So from conception to the end, to the issuance of the standard. So this is basically an overview of how any standard looks like. So first, the ISB consults the public to understand matters or problems that need their attention. So this is done through the agenda consultation. So it's basically the board asking the public, hey, do you have any problem that you need us to look into? Any matters that you would want us to address? So for IFRS 19, it started on that 2015 agenda consultation. So from that feedback, the ISB will then investigate and commence research. If the ISB thinks that it is feasible to address the concern, then it will start the standard setting process. It will start to think about what could be the solution that could cure or address the concerns. For IFRS 19, this started in January 2020. So once the ISB is satisfied that the requirements can be set out, then it will draft a pro forma standard and will ask the public for their views. So the basic question is, do they think the proposed requirements will address the problem? So this is done through an exposure draft. So for IFRS 19, the exposure draft was published in July 2021. Stakeholders are given 180 days or roughly 6 months to comment. After the comment period, the ISB will gather all the feedback, analyze them, and revisit their proposals. Are the proposed requirements suitable? Are they too difficult to apply? So the board considers every feedback, every single feedback from A to Z. So sometimes the ISB proceeds and confirms its original proposals, or sometimes it changes those requirements. And that all these discussions, all these deliberations and discussions happened in public. So if you go to the IFRS website, you will see, I think it's somewhere in the calendar options, all the public meetings that you could watch and observe. So after this thorough redeliberation, the ISB will publish the final standard. So the ISB for IFRS 19 completed its redeliberations in April of 2023. So between April 2023 and May 2024, the board worked on finalizing the drafting, so the wording of all the requirements. So in May 2024, the ISB issued the newest standard, the newest addition in IFRS standards, IFRS 19. So if you look holistically at the whole timeline, the board took about 5 years to develop IFRS 19, which is actually quick in the standard setting world. So usually other standards take more than 5 years. Some standards even take almost a decade just to develop. But for 19, they develop it quite quickly. So I'm going to talk about it later, why the board did this work quite quickly compared to others. Yeah. And then on the next section, I think I see some questions already coming in. So let those questions come in and we'll try to answer them. I'll try to answer them as much as I can. So let's talk about an overview of IFRS 19. So you notice, I said earlier that it's only some subsidiaries, not all, can apply IFRS 19. So we call this, the board referred to them as eligible subsidiaries. So meaning, of course, from the term, you have to be first a subsidiary. And to be able to use the standard, you need to meet these two criteria. First, the subsidiary does not have public accountability. And second, the parent has to prepare consolidated financial statements using IFRS. Now, the second criteria is actually quite self-explanatory. It's easy to understand. So my parent has to prepare IFRS financial statements. It's easy. You'll be able to check that immediately. And that parent can be ultimate parent, the one at the very top, or an intermediate parent, somewhere in the middle. So an intermediate parent is a parent that is also a subsidiary. The more complicated criteria is the public accountability bit. So what is public accountability? So you have a public accountability if your equity or debt instruments are being traded or in a process of being traded in a public market. So in short, if you're a listed company, listed entity in any stock exchange, then you have public accountability. That's because you accept money or funds from the public and you're technically bound, legally bound. You have duty to them. So that's one. Another aspect of public accountability is if you hold assets in fiduciary capacity. So basically, you're holding money in trust. So a good example of this, a very basic example of this, are banks. In Cambodia, not only banks have fiduciary capacity. It also, I think in Cambodia, we also have a handful of microfinance institutions that accept deposits. So in that case, those MFIs that accept deposits, they do have fiduciary capacity. So unfortunately, for those entities, for those companies, they will not be able to use the standard. Now, among the topics in the standard that attracted a lot of feedback from stakeholders is the scope. So when we were developing the standard, stakeholders told us, hey, this is actually a very good idea. You're making our lives easier. So we think you should actually open it up to everybody. You should not limit it to just subsidiaries. Let more companies be able to use it. However, different stakeholders have different views on how to widen the scope. Some stakeholders said, let all companies without public accountability be able to use IFRS 19. So not just subsidiaries, even standalone companies. So basically, IFRS 19 will have a similar scope as the SME standard. Some stakeholders said, aside from subsidiaries, maybe include as well those joint ventures and associates. They also have investors that need their accounts. Let them use IFRS 19. Some stakeholders also said, widen the scope by allowing subsidiaries that have parents that don't use IFRS. So for example, if your parent is located in the United States and they are using US GAAP, that's not IFRS, clearly. Let them have the opportunity to use IFRS 19. So basically, there's a lot of feedbacks. Half of them agree with the board. Half of them does not agree. They wanted to widen the scope. But all those who disagree with the board have different views on how to widen the scope. So the board observed that IFRS 19, being a reduced disclosure standard, is very much an entirely new scope, new approach to financial reporting. In fact, some regulators, some national standard setters in other jurisdictions felt a bit worried, particularly those that are not familiar with the reduced disclosure standard. Because, for example, if previously they are reporting under IFRS, and then you're telling me to cut down the disclosures, then that would mean less information to users, right? So for them, it's worrisome. So the board said, since this is a new approach, we wanted to err towards caution. We wanted to be cautious. Let's take it step by step. So the board decided that in this version of IFRS 19, for the initial version of IFRS 19, let's only limit it to eligible subsidiaries. And then maybe in the future, let's see how much take up, how does the market react, how does the regulators react. If everything are working smoothly as intended, if it's really generating all the benefits that they expect to generate, then maybe in the future, we will consider to open up the scope. Now, there are some small population also, particularly, I think this is in Europe. So particularly German insurance companies. Interestingly, for these German insurance companies, including life insurance, they said that they don't have public accountability, that they are just like any other company. Yes, they do accept funds or money from the public, but for them, in their view, it's their money already. Regardless of how they use it or how they spent it, it's not something like that they owe to customers. So for them, they think that they don't have fiduciary capacity. So the board said this is quite a very contentious topic. So what the board did is they will leave this to regulators to decide. So as you know, IFRS is being applied by the board only issued IFRS. The one who enforce application would be local regulators. So it's up to the local regulators to decide whether in their jurisdictions, based on customs and practices, are insurance companies publicly accountable. So with that background, let's look at these three scenarios. So who are these eligible subsidiaries? So in scenario one, so this is a pretty much straightforward example of what we have earlier. The subsidiary does not have public accountability, the one in the red text box. It has a parent that prepares consolidated financial statements using IFRS. Of course, in this scenario, the subsidiary is eligible. In the second scenario, we have a parent that prepares consolidated financial statements, but it's using local GAAP. So a framework that is not IFRS. So of course, in this scenario, the subsidiary is not allowed to use IFRS 19. In scenario 3, we have a parent that does not prepare. So the ultimate parent, the one at the very top, that don't prepare consolidated financial statements. But the intermediate parent that directly owns a subsidiary prepares consolidated reports using IFRS. And then in this instance, the subsidiary still doesn't have public accountability. Can the subsidiary use IFRS 19? So the answer is yes. It meets the two criteria. First, it's not publicly accountable. Second, it has a parent that prepares consolidated reports using IFRS. In this instance, it's the intermediate parent that prepares that report, those IFRS reports. So even though the ultimate parent does not prepare one, it still meet the criteria. So at least one of the parent at the top prepares consolidated financial statements. Okay. Now, let's test that knowledge and let me ask you this question. So assuming all these businesses are subsidiaries, so they are all subsidiaries, who among the following companies are eligible to use IFRS 19? So first option, a manufacturing company. A second option, a large utility company or a service provider. For example, like the Electric de Cambodge. Third choice, a non-deposit taking MFI. Or do you think all these companies are eligible to use IFRS 19. So you can see the QR code on your screen. So yeah, let me know what you think. I'm not sure if this particular poll is working because I don't see any response coming. Maybe it's taking time. But let me walk you through in each of these options. So the first option, manufacturing company. So clearly, this subsidiary don't have public accountability. So it would be eligible to use IFRS 19. So the second option, a large utility company or a service provider. So some stakeholders actually ask us a question, what if the subsidiary serves a very specific public interest, public duty? Say for example, they're the one who generate electricity to the company. So they are very much of public interest, right? Would they be considered publicly accountable? So the ISB said, not necessarily. So if that large utility or service provider company do not accept public funds, so if they are not listed, and they do just a usual common service business, although the scope of their work is so wide that they are very much of an interest for the country, then they can still be eligible to use IFRS 19. It's really on what finances your business rather than what kind of business you're into. How about a non-deposit taking microfinance? So a microfinance that only gave loans to public, its funds are coming from borrowings that don't take any money or funds from the general population. So in this instance, a non-deposit taking MFI is eligible to use IFRS 19. So the answer actually on this question is all of the above. So how did the board develop these reduced disclosures? So the ISB's main consideration in developing IFRS 19 is that despite the reduced disclosures, the resulting financial statements should still be useful to investors. Because if the financial statements are no longer useful, then it defeats the purpose of financial reporting. So even though you're providing or you're reporting with less disclosures, the financial statement should still be useful. So with that, what the board did is they look at IFRS standards, so the big book, all the IFRS standards, and then applied a set of principles that users find particularly important for companies without public accountability. And then it applied that like a filter. And then those that get filtered are the ones that goes inside IFRS 19. So those are the principles that we have in this slide. So information that provides liquidity and solvency, measurement uncertainty, etc. Now, these are the same principles. So these are not new principles. These are the same principles that the board used in developing the SME standard. So you may remember the IFRS for SMEs or CIFRS for SMEs in Cambodia are for companies without public accountability. IFRS 19, so in the title of the standard, are for subsidiaries without public accountability. In short, you can say that subsidiaries that can use IFRS 19 are subsidiaries that are SMEs. The board also noted that the disclosures in the SME standard, when they originally developed it, are actually based on IFRS and therefore already reduced. So because of that, the board, in order to save time and resources, used the SME standard as a leverage. It borrowed the thinking in the SME standard. So they used the SME standard as a starting point. So basically, to the extent that the recognition and measurement requirements in the SMEs are the same as in the big book in full IFRS, then the board said, then that must mean the reduced disclosures in SMEs should be sufficient also for subsidiaries without public accountability. So the board don't have to rethink all those thinking. Although the board did made some exceptions, but it's very few. So once the ISB has complete this analysis, what it did is to list. So what if you open up IFRS 19, what you will see is like a long list of all disclosures. But it covered the disclosures for all standards from IFRS 1 to IAS 41. So everything from A to Z. So the ISB, in developing the standard, used a cutoff of 28 February 2021, meaning all disclosures issued as at 28 February of 2021, that date, are considered for reduction. So that cutoff is necessary because IFRS, as everyone knows here, is a living literature. It keeps on evolving over time. It keeps on being amended, some being superseded, new standards being issued. So if the board wait for that to stabilize, it might not even finish IFRS 19 anymore. So in order to issue the standard, the board said, let's just have a cutoff here. Then all disclosures as at that cutoff, let's consider for reduction. Now, the cutoff is 2021. The board issued the standard 2024. So what happened on those disclosures, new disclosures that were developed between that gap? So on those like more than 3 years, right? So the board noted that new disclosures were developed on these 5 projects, 5 amendments. So the board said, because we were not able to consult, reduce disclosures for these 5 topics, then it's not appropriate to reduce them. So in order to make a proposal a requirement, the board need to do all those thorough consultation. So remember the bit that when we discuss about timeline, every stage of the project needs consultation with the public, with the stakeholders. And since the board was not able to consult yet on these 5 topics, the board said, someone applying IFRS 19, those companies will also be required to use all the disclosures here. So in the meantime, in that interim period, until the board consider these topics for reduction, for now, apply all the new disclosures that they require. So later, we will revisit that again. We'll definitely come back to the topic. Now, there are a couple of standards where disclosure requirements are not reduced. So these are IFRS 8, operating segments, IAS 33, earnings per share, and IFRS 17, insurance contracts. So let's talk about IFRS 8 and IAS 33 first, because they are different from the circumstances in IFRS 17. So for IFRS 8 and IAS 33, if you look at the scope of the standard, they are only required for companies that are publicly traded. So those that are listed. Meaning to say, a subsidiary using IFRS 19 are out of scope of IFRS 8 and IAS 33. They don't have to apply those standards at all. They can say, I don't have to provide those disclosures. So that's quite a big savings. You're not required to use that. But the board said, if for some reason the subsidiary opted or voluntarily provide information about operating segments or earnings per share, then in that instance, that subsidiary, aside from using those standards, they have to also apply all the disclosures on those standards. Now, IFRS 17 is sort of a different, as I said, a different story. So IFRS 17 is the standard for insurance contracts. The ISB observed that some subsidiaries, eligible subsidiaries, may still issue insurance contracts within the scope of IFRS 17. And because the standard introduces a new insurance accounting model, the disclosures required by 17 inform users of those entities' financial statements how they apply the model. So you have a new insurance accounting model. Those disclosures provides a better understanding on how you use that model. So the board said and decided that until that new insurance model is well understood by the public, by the preparers, and by the regulators, then there will be no reduction in the disclosure requirements for 17. But the board said that they will revisit this again in the future once IFRS 17 is implemented for a number of years. So those are the disclosures. So how do we expect an entity, a subsidiary, to apply IFRS 19? So again, IFRS 19 is a disclosure-only standard. It does not include recognition, measurement, or presentation requirements. IFRS 19 also does not reproduce guidance on applying those disclosures. So the recognition, those other requirements, and guidance will continue to be located or sit in other standards. So the board's reasoning is to keep the standard short and accessible. So I have here with me, so it doesn't include yet IFRS 19. Oh, I have a blurred background. Sorry, so you will not be able to see it. But if you pick up an IFRS book, the whole standards from IFRS 1 to IAS 41, it's actually, I don't know, more than 1,000 pages. So imagine if IFRS 19 will reproduce everything, then the whole IFRS book, bound volume, will be twice as long. So the board said, let's leave out all those other requirements in other standards. That's fine. And then if there are guidance available on how you apply those disclosures, then those guidance can still be used. You could still use it. The diagram on the right illustrates how an eligible subsidiary will apply IFRS 19. So for example, you're reporting items of inventory. So a subsidiary will go to IAS 2, so the main standard for inventories, to determine the recognition, measurement, and presentation requirements. For disclosures, instead of going to IAS 2, it will pick up IFRS 19 and just locate among the list of disclosures what are required for IAS 2. So the disclosures are arranged in order of standard. So you will be able to see quite quickly which disclosures are applicable to you. And then what about comparative information? So comparative information are those items, figures, and narratives that are reported for prior period. So if you look at this, the slide looks very complicated, right? But it's not. It's actually pretty simple. So the rule of thumb that you will think about is that you will provide comparative information only for information reported in the current period. So if that item is now, for example, you're using full IFRS previous year, but that disclosure are no longer required under 19, So when you move to 19, you don't have to reproduce that information again. So some frequently asked questions before I go to your actual questions, because I think there's already a couple of them. So let's just discuss this for a bit. So on the compliance statement, so investors actually place particular importance or premium on this disclosure. So the compliance statement basically tells investors whether subsidiaries has complied with IFRS. What financial reporting framework are they applying? So for investors, they find this really important. They put a premium on financial statements prepared under IFRS. So since, again, as I said earlier, IFRS 19 is part of IFRS standards, a subsidiary using IFRS 19 can also say that, hey, I use IFRS. But in that disclosure, they will also note that in using IFRS, they're also applying IFRS 19 as well. So what about fair presentation? So fair presentation, so this is a requirement in other standards, particularly in IAS 1, that says if you need to provide additional disclosures to better report or illustrate the information about your financial statements, about your performance, then you need to provide additional disclosures, even though it's not required. Similarly, if the disclosure requirement, if you look at if you look a particular requirement, and then that requirement, the information from that requirement is not material, is assessed to be not material, then you're also not required to apply the requirement. So it's not supposed to be a checklist. So that's basically this fair presentation requirement tells you to do. So this fair presentation requirement also applies to subsidiaries. So if the subsidiary thinks that additional disclosures is needed because they have maybe like a very complicated one-off transaction, then they have to provide more disclosures. If they think those disclosures required in 19 are not material, then they don't have to apply it. So what about interaction with IFRS 1? First time application of IFRS 19. So first time application of IFRS 19 does not in itself result in an entity meeting the definition of first time adopter. So IFRS 1 is basically the standard, the transition standard that an entity has to apply if they move from a different GAAP to IFRS standards. So it's quite, I will not say complicated, but it could be challenging to apply because you'll usually apply it the very first time. Well, not usually, but always. You always have to apply it the first time you apply IFRS. So an entity using IFRS 19, so if you're transitioning from full IFRS, you're already using IFRS, and then you decide, let's switch to reduced disclosures, IFRS 19, then you don't have to undergo IFRS 1 again. But if you're using, or if you're transitioning from local GAAP, so for example, if you're using CIFRS for SMEs right now, and then you move to IFRS 19, then you need to apply IFRS 1. The only difference is that IFRS 1 also has extensive disclosures. So instead of applying all those disclosures in IFRS 1, what you'll do is go to IFRS 19 and look at that short list of IFRS 1 disclosures you need to provide. Then that's it. And then on what financial statements can I apply it? So the subsidiary can use IFRS 19 and it's consolidated. So if the subsidiary is also a parent, they can use 19 in its consolidated financial statements, separate or individual financial accounts. Now, there is one topic here that is not included, but I think it's also particularly important to note, especially for auditors, because it's a practical question. So the question is, can a subsidiary use IFRS 19 more than once? So meaning to say, I'm using IFRS 19 now, The following year, maybe I decided, since it's optional, I can decide also I'll stop using 19. Or maybe your circumstances has changed such that you're no longer permitted to use 19. Maybe your parent company changed to US GAAP. So in that case, you cannot use 19 anymore. But sometime, years on, you become eligible again. Can I use IFRS 19 that time around, the second time around? So the answer to that is yes. Although, of course, we expect this will be quite rare, but it should not stop you. Because IFRS 19 should provide useful information to investors and users, then you can also use it more than once. Now, before I go to the next slide, I think there's already a couple of questions coming in. So let me just have a look at them and see if I could answer them. I think there's a question about benefits. So we have a number of slides dedicated about expected benefits. So maybe I'll park this later. There's a question about IFRS and GAAP. So when I said GAAP earlier, I'm referring to so GAAP stands for Generally Accepted Accounting Principles. So a company jurisdiction could permit multiple GAAPs being applied. So for example, in Japan, they allow some companies to use IFRS. They allow some companies to use their version of Japanese GAAP. So those are like, so a GAAP, local GAAP is a financial reporting framework that is different from IFRS. So usually local GAAP includes simplifications that are specific to those jurisdictions. There's a question. There's an interesting question about payment service provider. It is also under NBC, so National Bank of Cambodia. Can they be considered publicly accountable? So that's a question that we think the practice should answer. So giving the principles that we provided, so public accountable again are those that have fiduciary capacity. So you accept money from the public and you hold it in trust. Do you think you meet the criteria? So it's something I think is not a black and white answer. Something that practice and regulators probably will have to answer. There's a question about the difference between IFRS 19 and SMEs. So SMEs is actually a different framework. It's not IFRS. So we have, the board has, the IASB, International Accounting Standards Board, has two products. So one IFRS and the other is the SME standard. The SME standard is catered towards companies without public accountability with more simpler transactions. And because they have different users and they have less complex transactions, the accounting requirements are simplified. So for example, in SME standard, Cambodia is actually one of the big user of the SME standard. I just want to note that. So in the SME standard, you do amortization of goodwill. So you're not, unlike in IFRS, you're not allowed to amortize goodwill. You will never amortize goodwill under IFRS. Under IFRS, you need to do an annual impairment test, which is quite costly and complex to apply. So for SMEs, the board noted that particular requirement is so complex. So the simplification is, let's do annual amortization. Just looking at the other questions here. So what if the subsidiary has entered into hedging transactions? So transactions themselves does not affect your eligibility. So even though you enter into hedging transactions, if you are not listed and you don't accept money from the public and trust, then you can still use IFRS 19. So that's without question. You can still use IFRS 19. There's a question about, is there any gap between disclosures for hedge instruments and 19? Yes. So the board reduced the disclosures on hedging. Again, I just want to note, the board reduced only the disclosures. So the requirements as to how you recognize and measure those hedging instruments, those hedging transactions, remains the same. It's only the disclosures that's being reduced. There's a question about scope here. So if an ultimate parent financial statement IFRS, but intermediate parent is not public on okay. Yes. So in my illustration earlier, so in scenario 3, we have an ultimate parent, intermediate parent, and subsidiary. If in that scenario, the ultimate parent prepares consolidated financial statements using IFRS, then that intermediate parent, provided it doesn't have public accountability, is also eligible to use the standard. I really like the questions here. It seems like, yeah, that our audience actually find this interesting. There are liquidity and solvency related disclosures in the standard. So what those principles actually tells you, so I think this is a question about what we have, whether a subsidiary don't have to provide liquidity and solvency. So those principles are actually the items that users find important for companies without public accountability. So those are just guiding principles that the board use. So if this disclosure provide information about liquidity and solvency, then that means it will be required in IFRS 19. The board judged that disclosure to be sufficient and appropriate. There's a question about when to apply 19. So it's effective 2027. So again, the standard is voluntary. You're a subsidiary. If they think cost-benefit wise, it will be more costly, they will be disadvantaged to use the standard, then they don't have to apply it. It's effective 2027, but if you think you can apply it now, then you can already use it. Nothing stops you to use it. Is there any circumstances that a subsidiary apply IFRS 19 but management opted not to apply 19? Yes. Again, since it's voluntary, the management, usually the parent and the group, may decide not to use it for whatever reason. So on the compliance, there's a question about compliance statement. So in that compliance statement, so for entities at the moment, what you see in the compliance statement is that what it says is that the subsidiary, the financial statements are prepared using IFRS, full stop. What we expect for when IFRS 19 is being used, what we expect is that that disclosure would be along the lines of the financial statements has been prepared under full IFRS, under IFRS accounting standards, and in applying the standards, applied IFRS 19. So I think starting next year, if you guys are interested to see what could the disclosure look like, usually the big four accounting firms, so EY, Deloitte, PwC, and KPMG, issued illustrative financial statements annually. So most probably by next year, they will also have an illustrative financial statements that uses IFRS 19. So you will see what could that compliance statement disclosure could look like. Then there's a question about, this is a good question. Will the comparative period need to apply full disclosure? If we use IFRS 19 in the prior year, then in the current year, then it's no longer applied. So the answer is yes. Again, comparative information, the general requirement on comparative information is it has to support current period. So if you move out of 19 to just using IFRS standard, then that means you have to reproduce comparative information that you don't previously provide. How can we ascertain? So this is quite a good question. How can we ascertain if the group ultimate parent or intermediate parent is preparing consolidated financial statements based on IFRS? So usually, Usually, a parent-subsidiary relationship means an open communication. So usually, it's just it's an easy communication from the subsidiary to the group to ask them what the financial statements are it's based on. Particularly if those ultimate parent are listed, then those financial statements are easily available publicly. You could actually download it from the stock exchange. So usually this kind of information are the bits that you need to course through the management of the subsidiary. There's a question about, do we need to disclose anything in the financial statements if we are eligible to apply, but we choose not to apply IFRS 19? No, you don't have to. Because if you're, again, the standard is optional, it's voluntary. You're not required to use it. So if you decide to use the standard, if you decide not to use the standard despite being eligible, then that's fine. It's just mean that you're providing more disclosures than what IFRS 19 is required. So you're not losing anything. Again, IFRS 19 does not add anything new. It simplifies basically the life of how preparers prepare their accounts, how auditors audit the accounts. Okay, so I'll probably stop here for now. And if you have any other questions, let them come in. Now, I'm not sure whether I hope this poll question will work. I really hope. So on this slide, so we have like a word cloud here. I'm not sure if it actually works, but I wanted to maybe have a feedback of what you think about 19. It doesn't have to be one word. It can be a phrase. So you could see the QR code there. I just want to get your impression of what do you think about IFRS 19. So I'm hoping this particular poll would work. And I think that's also the end of our second topic. So I wonder if this is actually a good time to take a break. So while we're on a break, and you also have access to the materials. I think it's been shared as well. Have a look and submit your response on this poll question, and then maybe let's revisit it when we resume the webinar. I'm just looking at our team here in ComEd, so on how long our break could be. Uh, can I call on to our team in ComEd? Maybe Narin? How long can we have like a short break before we continue with the rest of the topics?
If it's me, we can have uh, maybe a 15-minute break. So,
Sure. I think that's fine. So let's have a 15-minute break. So I'm looking at my clock right now. I have to be conscious that my time is also, of course, different from your time. So if I'm correct, it's about 3:34 in 3:35 in Cambodia. So maybe let's resume at 3:50.
yes, 350 would be also good.
Yeah, in 15 minutes.
Okay, 350.
Yeah, and then try to answer this word cloud, and I'll check. I'm hoping we'll get the response soon. It seems like it's only the first polling question that works. But yeah, I hope to see everyone again. So we at the moment I can see more than 280 participants joining. That's a really good number. So I hope to see you again to see all these 280 participants in 15 minutes. Yep. I think that's a quick 15 minutes already. I hope everybody are still here. And I can see that the polling functions are now working. Yeah. So I like the responses here. So of course it's an IFRS, good for IFRS. Yeah, many stakeholders actually told us that yeah, that at least for this one, because if you look at other amendments or other standards that the ISB issued, it's adding requirements. So at least for this one, it's like hearing more, leaning towards preparers. It's like easing the burden on financial reporting. Of course, it's only for certain subsidiaries. It simplifies the preparation. That's right. Yeah, I like this. And then before we move on to the next topic, which is about how the standard will be maintained and maintenance, let me just answer some of the questions that were raised. Again, I just want to note and please come Ed if you want to correct me if I'm wrong. I think all the materials are shared in the link. It's also, I think the link to the materials will also drop in the chat. So those are, I think, very easily for everyone to download. And of course, to access any further reading. There's a question here about, let me just read this. So certain jurisdictions apply IFRS, but in such a delay manner for new standards issued. So example is in Thailand, normally delays of 2 to 3 years in adopting new IFRS 15 and 16. So revenue standard and leases. So after 2 to 3 years from their original effectivity. So after they are effective, TFRS, so Thailand Financial Reporting Standards, are then equivalent to IFRS. So in this particular example, can we say TFRS is equivalent to IFRS? And as a result, the subsidiary of a parent in Thailand can apply IFRS 19. So I think this is quite an very useful and practical question to answer, particularly when auditors face this challenge or even for regulators. So for everyone's information, there are some jurisdictions, not all, that modifies the requirement in IFRS, but they still call it like something equivalent or similar to IFRS. So in Europe, for example, here in Europe, they call IFRS not IFRS. So they call it Europe adopted IFRS or IFRS as adopted in Europe. So there's always that caveat, that reservation. It's because Europe actually did not adopt everything. So for example, they did not adopt the standard on rate-regulated activities. They also carve out, so they don't adopt IFRS 9, financial instruments in full. So they actually carve out the macro hedging requirements in IFRS 9. So for them, they call it IFRS as adopted in Europe. So what we expect is when different jurisdictions adopt or make IFRS 19 available to them, then they will also adopt it consistent with their local practice, local framework, local regulation. So IFRS 19 will become TFRS 19. And most probably the criteria that it has to be applied using IFRS, they will call it also based on TFRS. Because technically in Thailand at the moment, there's no IFRS. All IFRS is TFRS. The same thing in Cambodia, no matter how identical they are, you don't call it IFRS. You call it Cambodian International Financial Reporting Standards. And that is the same thing in the Philippines. We don't call it IFRS, it's PFRS. So once you adopt 19, we expect that, of course, all this kind of adaptations would be made. So the question is, in that instance, can a subsidiary in Thailand use what will be then TFRS 19? So the answer is yes. Now, it would be a bit more difficult to answer. You will go into gray area. So for example, TFRS. So your parent is located in Thailand. And then you have a subsidiary, and that subsidiary is eligible to apply IFRS 19 in Cambodia, in Phnom Penh. So as far as Phnom Penh or CIFRS standards are concerned, what you'll have there is probably parent that prepares Cambodian International Financial Reporting Standards. If that CIFRS does not equal or equate to TFRS, because, for example, Thailand has not adopted yet IFRS 16, whereas Cambodia has adopted already CIFRS 16 as part of CIFRS standards. Then in that instance, auditors, management, and regulators have to make a judgment whether in this instance, are we going to consider them as equivalent? So that's actually a very good, interesting question to ask. Sorry. There's a question about, can you provide examples of how IFRS 19 is applied in practice? So the answer is, I cannot. So at the moment, so as I said earlier, IFRS 19 is only issued in May 2024. So that's, literally last month, right? So no matter how I'm biased here, no matter how I think IFRS 19 is good for companies, I doubt if there's already someone already using it after a month it's being issued. Most probably they're still doing all these assessments. We expect probably there would be some who would start using them maybe next year or in a few years' time. And then there's a question about, is there any conflict or difficulty for those subsidiaries to apply both IFRS 18 and 19 at the same time? That's a very good question. So for those of you who are closely following IFRS, if you're like an accounting nerd like me, you will note that IFRS 18, so the presentation and disclosure in financial statement standard, which replaced IAS 1. So by the time IFRS 18 become effective, there's no more IAS 1, was issued, I think, roughly a month before IFRS 19. So they're only a month apart. So there's no conflict. IFRS 18 has the same effective date as IFRS 19, 2027. If a subsidiary decided to use IFRS 19 before IFRS 18, so for example, I early apply IFRS 19 this year, but IFRS 18 is not yet effective, right? So that means as far as the world of IFRS accounting standards you are applying is concerned, it's as if IFRS 18 is not yet issued. So what you're applying would be requirements, including disclosure requirements based on IAS 1. Now, the board is aware that this could happen. So if you open up the standard, what you will see is that the disclosures, since it's effective 2027, the disclosures are based on IFRS 18. But there is an appendix, I think if I'm not mistaken, it's Appendix B of IFRS 19 that says, if you decide to early apply IFRS 19 and you apply 19 before 18, then you don't have to apply the disclosure set out under IFRS 18 section. In that instance, what you do then is to apply the disclosures under IAS 1 that are set out in Appendix B. So the board is actually aware that that concern would arise. So that's a very good question. I mean, yeah. So keep those questions coming. So I'll proceed now on our third and fourth topic. So how IFRS 19 will be maintained. So we know that IFRS standards is a living document, as I said earlier. It's kept on being updated regularly. So actually, back when I was in audit, I also complained a lot. Why is IFRS standards keep on being updated? There's new requirements coming in. So there's still a lot of learning to do. So it's a living document. So since IFRS 19 is part of IFRS, the standard has to go and be consistent with other IFRS standard as they are being amended. So what the board did is, if there's an amendment on one aspect of other standards, they will also consider at the same time whether to amend IFRS 19. And they will also do the consultation with stakeholders at the same time. So it all saves time and resources. Earlier, if you remember, I highlighted like these 5 topics. So non-current liabilities covenants, supplier finance. So topics that were not reduced because of cutoff. So these are the topics that fell into that gap between the cutoff of 2021 and issue date of 2024. So what the board did, as I said earlier, is at least in the interim, those disclosure will all be applicable in full if you apply IFRS 19. So at the moment, right now, I'm also part of the team who's working on updating IFRS 19. So that work, that updating are on these 5 topics. So what we're doing is asking the public, so that exposure draft will be issued next month, end of next month, asking people whether and if so, how, do they agree about the reductions that we are proposing on these 5 topics. And then after that, the edition of IFRS 19 is completely aligned with IFRS standard. And then any other future amendments that the board do, they will do at the same time on updating IFRS 19. So this is just basically just tidying it up, making it a level playing ground for all standards. Now, let's talk about the expected effects and benefits of 19. So I think there's a couple of questions earlier about this one. So this bit of the presentation should actually answer those concerns. So the benefits for companies, so let's talk about benefits for companies first, depends on the starting point of the subsidiary. Is the subsidiary using local GAAP, SMEs, or IFRS? For subsidiaries that are currently applying local GAAP or the SME standard, the main benefit is avoiding dual reporting. So they don't have to do dual accounts. With the use of IFRS 19, the subsidiaries will be able to use the same accounting policies as their parent, as appropriate, of course, and they will no longer need to keep additional set of accounting records. Auditors don't have to do anymore those adjustments, which is sometimes can be manual. There's some judgment involved. So one interesting feedback that we heard when we were preparing the effects analysis of the standard is that IFRS 19 will greatly benefit shared service centers. So what is a shared service center? So some groups or conglomerates had a central financial reporting function. So for example, like all subsidiaries in Asia, so they have one operations in one region, they centralize the financial reporting function, say somewhere in India or in Manila. So the Philippines actually has a very huge business on shared service centers. So these shared service centers, or SSCs, preparers told us that it requires a lot of expertise on local gaps. So by using IFRS 19, these shared service centers will avoid the need to have those expertise. So imagine all those costs and effort involved on being kept up to date on the local requirements. They will no longer need to do that with IFRS 19. So that's usually the big selling point for local GAAP or SMEs. How about for those that are currently using IFRS? So for those subsidiaries, the main benefit, of course, obviously, is the fewer disclosure requirement. Fewer disclosures would mean saving time and effort in preparing financial statements. And hopefully, it also helps auditors on auditing audit time spent on doing the work. Now, according to the preparers that we interviewed, IFRS 19 could also result in by improving the quality and usefulness of subsidiary financial statements and consistent approach to preparing those financial statements. So I have that illustration later. So let's park that for now. There's also a reduced risk of non-compliance. So remember my example earlier, the feedback that we got from preparers, that shared service centers will no longer need to do local GAAP. They don't have to learn, they don't need to have all those local expertise. So imagine a shared service center in India that needs to know what the local reporting requirements are in Manila, in the Philippines. So they no longer have to do that. And because of that, it reduces the risk of non-compliance. Now, there's one huge company that tested the proposals. So this is based on the exposure drafts. Of course, the proposals and the exposure draft has been changed. But at least based on the exposure draft, what they learned is that for them, there's a 64% reduction in the disclosure requirements that they provide. There's also a 14% reduction in the length of the notes. And then we also did a high-level test of, it's a very simple, straightforward comparison of some standards. So what we notice is that for IFRS 12, there's a 68% reduction in the volume of disclosures. IFRS 15, 52%. IAS 12, 50%. IAS 16, 60%. So there's clearly a benefit of using the standard. So aside from simplified financial reporting, because you don't need to do dual reporting, there's also savings and benefits coming from fewer disclosures. Now here, let me illustrate the potential to improve the quality of financial statements. So the scenario on the left, we have a subsidiary that is not applying IFRS 19. So it uses local GAAP for statutory reporting, SR. So those letters there are just like random numbers, just to illustrate. For that subsidiary to prepare IFRS consolidated numbers, it has to do those adjustments. For example, some fair value adjustments, some impairment adjustments. So the adjusted amount, the one at the bottom, is based on IFRS. That is the amount that will be taken up by the parent for consolidation. Now, some quick observations. In some circumstances, what we learned is that the starting point is reverse. So there are some group of companies, the way they did it is they start with IFRS and then they convert to local GAAP for statutory reporting. That indeed happened. And then the reconciliation are done by both a joint effort by the subsidiary and the parent through their shared service centers. Now, these reconciliations to some extent are automated, but always have manual involvement. So even to some extent, there's some automation involved, but there's still some manual involvement that needs to be made, especially when there's judgment involved. For example, when you're doing estimates, you cannot automate an impairment calculation. For you to estimate your cash flows, there's a lot of estimates and judgments involved there. Now, looking at the scenario on the right, so we have someone that's already applying IFRS 19. Again, using IFRS 19, the subsidiary is already using recognition and measurement requirements under IFRS. So as far as they're concerned, the numbers that they will provide to their parent, the numbers that they prepare for their local accounts based on IFRS will be basically the same numbers that the parents has to take up for consolidation purposes. So by avoiding the need to maintain dual accounts, you improve the quality of your financial reporting process. So on the left scenario, you need to make adjustments. Often, this judgment requires you to make estimates and hence judgments. Some investors, during the consultation period on the exposure draft, told us that by avoiding these adjustments, you will potentially improve how subsidiaries apply IFRS, thereby improving the quality of the financial statements. In short, It is similar to using the same global accounting language. It's as if the whole group talks clearly with each other using IFRS. So before I move to the next slide, that's very much, so think about it like a language. So at the moment, well, with a few exceptions maybe, all of you would probably be speaking in Kamay. I'm speaking in English. And I can see, which I'm still fascinated, that there's a functionality now that it translates automatically the language from English to Kamay. Wouldn't it be easier if everybody speaks the same language? So think about those adjustments. So you have a Kamay, I'm speaking in English, system make a judgment to translate it to Kamay. How accurate it is? Is it? Is it 100% accurate? Who knows, right? Imagine if everybody are speaking the same language. It avoids miscommunication. It's the same thing with IFRS 19. It basically simplifies communicating within the group. Yeah. Again, enabling a single financial reporting language, which would be IFRS. Now, talking about benefits for users of subsidiary financial statements. So in developing the standard, the ISB sought to balance requests from companies for reduced disclosure requirements and information needs of users of financial statements. It has to always to be balanced. Your financial statements that you prepare have to be useful to your investors, to your users. So as noted earlier, the ISB in developing the reduced disclosures considered certain principles that users find important. Now, the ISB was able to verify that those principles are still appropriate because during the time that the board was developing IFRS 19, it's also in the midst of updating the IFRS for SME standard. So through that project, so the board was able to leverage work on one project to the other. It's being efficient. So the SME project team was able to confirm that those principles are still the ones that investors particularly look into. So the board said, then it's confirmed. We could make use of those principles to guide us to determine what disclosures to require and what disclosures we can reduce. And then here, benefits for jurisdictions. So the main concern in IFRS, particularly for emerging economies, is that they can be complicated to apply. Let's accept it. It's really quite complex. Even the drafting can be a bit difficult to read, right? IFRS 19, as I said earlier, would make the application of IFRS more accessible. As we illustrate earlier, this could result to better quality financial statements and better application of IFRS. In a way, this enhances comparability, which is useful to investors. So what do we mean by comparability? So usually when an investor makes decisions, investment decisions, whether to retain, increase, or decrease their investments, it does a comparison of their investment to another company. To make that comparison, it has to be apple to apple or oranges to oranges. It cannot be apple to oranges. It cannot be based on US GAAP and the other is based on IFRS. They won't be comparable. So by IFRS 19, there would be greater application of IFRS, which could potentially increase, would enable investors to ease their work on making their investment decisions. So that said, investors actually place a premium on financial statements prepared using IFRS. So with investors looking to alternative investments outside their usual targets, this could help actually increasing foreign direct investments to some jurisdictions that will enable the use of IFRS 19. So the reason I said that is that different countries, different jurisdictions have a different way of using IFRS. In some companies, in some jurisdictions, the use of IFRS is automatic. So when I say automatic, once it's issued, it's already also applicable to them immediately. Some countries, some jurisdictions, like in Europe, had to go a strict and thorough endorsement process. So they need to check whether are the requirements here consistent with their legal framework, things like that. So again, the reason why Europe does that is because when the board develops standards, they don't generally consider specific jurisdictional legal frameworks. That's because the remit of IFRS Foundation and ISB is global. We cannot just focus on what is appropriate in Europe. It has to be responsive to everyone in the globe, even here, there, in Southeast Asia. Now, let's have this quick illustration. So here we have 3 scenarios. So say we have Group X, so the parent company that operates in 5 jurisdictions, A, B, C, D, and E. And the parent is located in jurisdiction A. So in scenario 1, all 5 jurisdictions where the group operates adopt IFRS 19. So this is the perfect scenario. The group will be able to derive maximum benefits from IFRS 19. In scenario 2, all jurisdictions except jurisdiction B adopt IFRS 19. For this scenario, the group still enjoys lower cost of doing business with the exception of jurisdiction B. In scenario 3, all jurisdictions except jurisdiction A, where the parent operates, and jurisdiction B adopt IFRS 19. So they don't apply IFRS 19. Only B, C, and E applies 19. For this scenario, the group still benefits even though the parent's jurisdiction does not adopt IFRS 19. So what does this tells you? The more jurisdictions apply it, the greater the benefits could be realized. And even though the parent's jurisdiction do not apply the standard, ultimately they realize some benefits. This also shows us that the benefits of applying IFRS 19 is not limited. It may be concentrated to the subsidiary, but much of its benefit could also go up to the group or to the parent. So here in this slide shows what we have heard from jurisdictions. So at last year's 2023 World Standard Setters Conference, the ISB hosted a panel discussion with other standard setters, national standard setters. So with New Zealand and UK. So those 2 jurisdictions already have their own reduced disclosure standard. So something like IFRS 19. And then other participants include Poland and Mexico that do not have a reduced disclosure framework. So the standard setters shared their experiences with the reduced disclosure standard and their expectations for IFRS 19. So similar framework has been applied in New Zealand and the UK. And during the discussion session, they said the popularity of those frameworks. And indeed, there are benefits from enabling it to be used by companies. In fact, in the UK, specifically where I am in, their reduced disclosure standard is being used not only by subsidiaries, but even by standalone companies. So for Mexico and Poland, they explained the necessity of the standard in their respective jurisdictions and expressed their support for the project. In fact, a couple of weeks ago, I think Mexico just issued their local equivalent of IFRS 19. They're also consulting. So I think Mexico is being a bit more, not really aggressive, but maybe more liberal. So they're actually reducing further disclosures. So in summary, the main benefits of the standard is that it simplifies and reduces costs of preparing financial statements without compromising users' information needs. So the financial statements, again, it's important, will always be useful. So even though the subsidiary is providing less disclosures compared to IFRS, the financial statements are still fit for investors' purpose. With the use of the standard, the subsidiary would be able to apply IFRS with less disclosure requirements, which will result in the simplification of the group reporting process. Currently, again, groups are preparing and using dual accounts. Some groups use consolidation pack to convert the financial statements, and both practices requires complex and costly systems and processes. 19 will resolve those concerns. And better yet, could potentially improve the application of IFRS standards. Also, subsidiaries' financial statements will be focused on their users, because the disclosures and the standard are again specifically considers users' information needs. All these benefits would translate to systemic long-term benefits in the financial reporting ecosystem. Now, those are the benefits. What are the costs? So similar to benefits, transition costs depend on specific circumstances of the subsidiary, mainly the financial reporting framework that they are currently applying, whether they're applying local GAAP, SMEs, or IFRS. If they are currently applying local GAAP or the SME standard, then they have to change their systems and processes to the extent that the recognition and measurement requirements differs between that framework and IFRS. Because of course, if the way you measure an item is different from between local GAAP and IFRS, and you move to IFRS 19, then you need to make those systemic adjustments. Then they also need to identify disclosures that they have to provide. IFRS 19 facilitates this because the standard lists all the disclosures that you have to provide. Now, if the subsidiary is already using IFRS, then there is less change in the system and process because IFRS 19 is still IFRS. What these companies' subsidiaries need to do is to identify then how and what disclosures they don't have to provide. Again, IFRS 19 facilitates this. Now, there are other factors that could affect transition costs. So the number of subsidiaries who will apply. As we shown earlier, the greater the number of subsidiaries using IFRS 19, the greater the benefits would be to the group or the parent. Second, the size and complexity or materiality of the subsidiaries' operations. So for auditors here, you will know that in our group audits, we are given a scope. Is it full scope, limited scope, or specific scope? The more material the subsidiary is, the greater, possibly, the greater disclosures that they may have to provide. Then in those instances, maybe, at least for those subsidiaries, full IFRS is better than IFRS 19. But some groups may have multiple smaller subsidiaries. So moving them on IFRS 19 will result to significant cost reduction and simplification. Again, the management or the parent, probably that would be the parent who will dictate it, can decide to move some of its subsidiaries to IFRS 19 while keeping current practice for others. IFRS 19 offers this flexibility. Another factor is applicable law and regulation. So for example, again, I'll use Europe as an example. Some tax rules in some smaller countries are linked to local gaps. So meaning to say, whatever their accounting local GAAP requirements are, those are their taxable income immediately. Unlike in some jurisdictions like in the Philippines, and to some extent in Cambodia, you need to make adjustments in your financial reporting amounts. So for these subsidiaries, if they use IFRS or IFRS 19, this would mean that they need to do a reconciliation to tax numbers, resulting to one of the most complicated topics in IFRS, deferred tax accounting. No one likes deferred tax. So before I end this slide, again, I want to emphasize the standard is voluntary. Subsidiaries and groups can decide, considering their own unique circumstances, whether to apply the standard. If they think overall it will be more costly or they will be disadvantaged with using IFRS 19, then they don't have to apply the standard. They could just continue what they're doing, keeping their status quo. So with that, let's go to our last poll. So what do you think is the most important benefits of applying IFRS 19? So we have three options here. Disclosures are targeted to users of subsidiary financial statements. Second option is improved knowledge and application of IFRS. And third is simplifies and reduces the cost of preparing subsidiary and group accounts. Can you rank them from 1 to 3? What do you think are the most important benefits or most interesting benefit that will be brought by applying IFRS 19? I'll give you a couple of minutes to answer that. And let me refresh the slide because I think that's the reason why it doesn't show the result earlier. Yep. I can see some of the responses coming in already. Let me share my screen again. There it is. Yeah. I think I do agree with the responses here, particularly the first one. So the greatest benefits really is that it simplifies and reduces the cost of preparing subsidiary and group accounts. That's good. I don't think the order will change anymore. Most probably this would be the answer for this session. Okay. So let me just move on to the next slide. I think my screen. Sorry, I think I'm having some technical problems with my slides here. It's actually not responding. Anyhow. Yeah. So these are, if you have access to the deck, I actually included some useful links for you to access if you think it's useful. So these are the resources that are available to you if you want to know more about the standard. So a link to the standard and the basis for conclusions. I will particularly highlight for you guys to read also the effects analysis as it shows what benefits and cost considerations you need to consider if and when you decide to apply IFRS 19. There's also a series of webcasts that we publish. I presented the overview of IFRS 19. So there's also a webcast with the regulator. And there's also a webcast with the preparer. And then, of course, the link to the World Standard Setters Conference last year. I think with that, thank you so much, everyone. Let me now go to some of the questions. There's already some questions coming in. So let me try to answer some of them. So there's a comment about, it seems that IFRS 19 is IFRS for SME. It's not. It's because SME standard has different reporting requirements. And SME is a different financial reporting framework. So SME, if you look, the foundation monitors actually how many jurisdictions apply SMEs. I think for IFRS, there's more than 140 jurisdictions that has adopted or permit the use of IFRS. Whereas for IFRS for SMEs, I think it's more than 70. So by using IFRS 19, you could actually change that, hey, this is now an IFRS financial statements. I'm just looking at other questions here. So if an immediate parent, so not publicly accountable, opted not to use IFRS 19, but the subsidiary opts to apply IFRS 19, then the consolidated financial statements for the immediate parent would still require collect full disclosures for the subsidiary for consolidation purposes. Well, not necessarily. So if we are talking about a material subsidiary, so for example, a subsidiary that is so huge that it's the same size as the parent, then most probably they will require all the same disclosures. But if the subsidiary is quite small, so based on materiality, so auditors here will understand this. So if you're given like a very limited specific scope, then you don't usually provide all the disclosures to your parent. They only require you to certain disclosures. So in that instance, so depending on how, that's what I was saying earlier, depending on how material the subsidiary is, that could affect whether or not you will apply the standard. Then the other question, do the branches and representative office need to prepare financial statement? So the question on whether who should prepare financial statements is a regulatory question. So it's not really the IFRS Foundation's remit to tell you when to prepare financial statements. So usually each jurisdictions will tell you if you meet certain qualification like a turnover or number of employees, then you need to prepare financial statements. So there's a question here also, if a subsidiary is not publicly accountable, but it's not using IFRS, so it's local GAAP, then it can still apply IFRS 19 or does not change in the process or system in the early year. So if a subsidiary is currently applying local GAAP, they can use IFRS 19 provided that they have a parent that prepares IFRS financial statements. So that subsidiary can move from local GAAP to IFRS 19, to IFRS standards. So that's actually the main problem that the board is addressing, that companies or groups will avoid the need to maintain dual accounts. Because at the moment, that subsidiary will need to prepare adjustments. Either the subsidiary or the group need to prepare adjustments to convert their local accounts based on local GAAP for consolidation to IFRS. Will there be a sample disclosure checklist? That's a very good question for the disclosure requirements in 19. I know I should not say this, but if you actually open IFRS 19, the standard itself is actually like a disclosure checklist because it's a disclosure only standard. It lists from IFRS 1, IFRS 2, down to IAS 41, what the disclosures you need to provide. So in effect, that's actually like a disclosure checklist. Just checking if there are other questions. So we have accounting standard continue with IFRS 20. Yeah, maybe. So it's not yet confirmed. The board is still yet to formally say that, yes, we will issue IFRS 20. But at the moment, the board is working on the new rate-regulated standard, rate-regulated activities. I think, if I'm not mistaken, I'm just looking at the IFRS book at the moment. So that's regulatory deferral accounts. So that's IFRS 14. So the board is working on a new standard that will replace that standard. So if the board decide to finalize this new standard, IFRS 14 will be superseded and it will be replaced by IFRS. What would be then IFRS 20? Great. I think I really like the question that have come in. So it shows interest to the topic, not only with 19, but on the greater work of the board. So I just want to check if there's any other questions. If there's none, I think, we actually went overtime for 5 minutes. Let me hand it over to you back, Casey.
Jan, I just want to say thank you very much for sharing your time and your expertise. And you have a great skill as a teacher. I love your voice. You speak very clearly, going through the standard step by step. and very much appreciate that you've taken the time to very thoughtfully answer all of the questions that our participants have posed. Thank you very much for sharing your time with us from London and your Saturday morning. And I wish you a wonderful weekend and all the best of luck to you. Everybody in Cambodia, we're very proud of your success in the profession, and we wish you continued success. Thank you very much.
Thank you so much, Casey. It's my pleasure.
And for all the participants here, thank you very much for joining us. This is a type of workshop that we arrange periodically from time to time when there are new standards issued or draft standards. So we do not have a regular schedule. We follow the schedule of the board and when standards are issued. So just keep in touch. And when there are new developments, we will also work to arrange new webinars. Thank you very much, everybody. Have a wonderful weekend. Have a wonderful Saturday, and hope to see you again. Bye, everybody.